Let us see A part of the question. A part of the question is, you are required to calculate appropriate cost of equity for KLM based on data available for proxy entity. Everybody is requested to stop writing. Let me explain you. Friends, basically this is a question of mergers and acquisitions, wherein concept of portfolio management has also been included, and this question was asked by institute in examination. Actually, this question is consisting of a concept called beta of asset that we are going to study in detail in our very simple chapter, portfolio management. In order to calculate A part of the question, I will be doing certain working which is of portfolio management, which is difficult for you to understand thoroughly right now. However, once you study portfolio management chapter in that beta of asset concept, afterwards it will be very simple for you to understand, say, this part of the question. Over here, we are required to calculate the cost of equity for KLM by taking into account information of proxy firm. It is required to be calculated something like this. Everybody stop writing, let me explain. Working note number 1, calculation of beta of asset, that is risk of new line of business. Risk of new line of business. Let us see that how to calculate this answer. Beta of asset into 1 minus weight of debt into tax rate is equal to beta of equity into weight of equity plus beta of debt into weight of debt. This is the formula to be applied. Students are requested to consider over here. As far as the proxy entity is concerned, for that you can see that debt equity at market value is given 1:4. For proxy entity, debt equity is given 1:4. Debt equity. 1 rupee is debt finance for every 4 rupee of equity finance. So total it is 5 rupees. 1 divided by 5, that is 0.20. 4 divided by 5, that comes to 0.80. Summation of that is 1. In a way, that's the weight of debt finance is 20%, weight of equity finance is 80%. By applying this equation, in our very simple chapter of portfolio management, we are going to study this in detail. We'll make the calculation of beta of asset as balancing figure. So beta of asset is equal to beta of equity. For proxy entity, you can see that equity beta is given 1.10 into weight of equity finance, that is 0.80, plus beta of debt finance 0. You can see that the question itself is providing information after the table. Assuming gearing of KLM is to be same as ABC and debt beta of 0. So beta of debt finance 0 into weight of debt financing 0.20 divided by, this goes on the other hand, so it goes in the division. So 1 minus weight of debt finance 0.20 and tax rate is provided to us as 30%. So by applying this equation, we will make the calculation of risk of the new line of business. We will make the calculation of beta of asset, that is risk of the new line of business. Once we compute risk of new line of business, then we are required to make the calculation of the beta of equity for KLM. Working note number 2, calculation of beta of equity of KLM, that is target company. Let us see that how to make calculation of the answer. Once again the formula is same, beta of asset into 1 minus weight of debt into tax rate is equal to weight of equity into beta of equity plus weight of debt into beta of debt. The formula is exactly the same as what we have applied say in the first working note. You can see that the question is providing information. Assume gearing level of KLM. Gearing level of KLM means the capital structure of KLM is same as for ABC. For ABC you can see that so the capital structure is given debt equity 1:3. So debt financing, equity financing. 1 rupee of debt financing for every 3 rupee of equity finance. So total it is 4. 1 divided by 4, 0.25. 3 divided by 4, 0.75. Total it is 1. Beta of asset, whatever answer that we have calculated in the first part, that is in the first working note, that we will keep as beta of asset into 1 minus weight of debt finance 0.25, tax rate 0.30. So beta of asset into 1 minus weight of debt finance into tax rate is equal to weight of equity 0.75 into beta of equity, say which is required to be calculated by us, plus weight of debt finance weight of equity finance is 0.75 and weight of debt finance is 0.25 into say beta of debt finance is 0. So we understand that say this element goes down to 0. Whatever is the answer of this component, divided by 0.75, with that you can make the calculation of beta of equity as balancing figure. Whatever is the answer of this component divided by 0.75, that is the answer of beta of equity over here. That is the way, so we are required to make the calculation of beta of equity that is say in the A part of the question. Then you can see that RF is provided to us and RM is provided to us in the third part of the question. RF is 4, RM is 10. So taking RF, taking RM and beta of equity like this and beta of equity like this, which we have calculated in the second working note, will make the calculation of RJ, that is cost of equity, by applying CAPM, capital asset pricing model. Friends, please write down a note. I am dictating a note to you. First point, beta of asset means risk of any line of business, full stop. Second point, overall risk for any line of business, always remain same irrespective of irrespective of capital structure that company maintains. Full stop. Third point, in order to calculate cost of equity comma for KLM we have to find beta of equity full stop. In order to calculate beta of equity, we will calculate beta of asset for KLM line of business. Full stop. In order to calculate risk of that line of business, we will calculate beta of asset taking proxy firm into account. Full stop. For that its equity beta and its capital structure will be considered. Full stop. With paragraph write down, after calculating beta of asset, we will consider capital structure of KLM, to calculate beta of equity and then KE will be calculated. Full stop. Working note number 1, calculation of beta of asset, taking into account information of proxy firm. beta of asset into 1 minus weight of debt financing into tax rate is equal to beta of equity into weight of equity plus beta of debt into weight of debt. Capital structure of the proxy firm is debt equity ratio 1:4. So 1 rupee of debt financing for every 4 rupee of equity finance. So the total 5 rupees is financed in this proportion. Weight of debt 20%, weight of equity 80%. That is 1 divided by 5, 4 divided by 5. Solving this equation, we are required to find beta of asset. Beta of asset into 1 minus weight of debt 0.20 into tax rate 30% is equal to beta of equity 1.1 into weight of equity 0.8. Weight of debt financing 0, beta of debt financing 0 and weight of debt financing 0.20. So 1, product of this 2 is 0.06. Product of this 2 is 0.88. This answer is 0. Beta of asset is 0.88 divided by 0.94, 0.9362. Please take down answer from board. Working note number 2, calculation of beta of equity for KLM. Beta of asset into 1 minus weight of debt into tax rate is equal to beta of equity into weight of equity plus beta of debt into weight of debt. Over here, we understand that say we are required to take the capital structure of KLM, which is same as of ABC. Debt equity is 1:3. So 1 rupee of debt for every 3 rupees of equity. So 1 divided by 4, 25% debt finance. 3 divided by 4, 75% equity finance. We already have beta of asset 0.9362 into 1 minus weight of debt finance 25% into tax rate 30% is equal to beta of equity, which we are required to find. Weight of equity 0.75 plus beta of debt is 0 into weight of debt financing 0.25. Product of this two is 0.075. 0.9362 into this is equal to 0.75 beta of equity. This element goes down to 0. So beta of equity is answer of this equation divided by 0.75. So it is 1.1546. Please take down answer from board. Working note number 3, calculation of RJ, that is cost of equity. It is RF plus beta into RM minus RF. Risk-free rate of return is 4%. Beta, which we have found, 1.1546. RM 10, RF 4. 10 minus 4, it is 6. 6% into 1.1546, 6.93% added to 4%, so it is 10.93%. Please take down answer from board. Let us see B part of the question. The question is, you are required to calculate a range of values for KLM both before and after any potential synergic benefit to XYZ Limited of the acquisition. So, we are required to make the calculation of range of values for KLM before and after any potential synergic benefit, in a way that, say, if at all there is no synergic gain, and if at all there is synergic gain. A range of values are required to be calculated if at all there is a situation of no synergic gain. What is the minimum value that we are ready to offer, and what is the maximum value that we are ready to offer? That is what we are required to calculate. And if at all there is synergic gain, because you have been provided with the information that earning will increase at the rate of 10% due to acquisition of KLM. So, if at all there is increase in the earning by 10%, there is synergic gain, then what is the minimum value, what is the maximum value that we are ready to offer is required to be calculated. Now, as far as institute suggested answer is concerned, institute has given suggested answer wherein valuation is made based on price earning ratio and valuation is made based on dividend discount model approach. There are two values that they have calculated. One value that they have calculated is based on PE ratio method basis, and another valuation that they have done is based on dividend discount model approach. Like that, so the valuation is done. Everybody is requested to stop writing. Let me explain you. Let us say that there is a situation of no synergic gain. Let us say that there is a situation of no synergic gain. Then valuation is made first of all, say, based on proxy entity information. Based on proxy entity information. It is like this. Proxy entity for KLM. For that you can see that the price earning ratio is 12 times. There is no synergic gain. So you can see that in the first part of the question, that is the first information. Profit after taxation for KLM for the financial year which has just ended is estimated to be 10 crore. So earning after tax is 10 crore into price earning ratio 12 times. With that, so the valuation is made, it is 120 crore. Based on proxy entities information of price earning ratio in a situation of no synergic gain, this is the value that we should offer. Then similar working is made based on XYZ information, that is the acquiring company XYZ information, wherein you can see that the price earning ratio is 10 times. Wherein you can see that the price earning ratio is 10 times. So it is 10 crore into 10 times. That comes to 100 crore. So if at all there is no synergic gain, then based on price earning ratio, these are the values. Valuation is made based on proxy entity information. Valuation is made based on acquiring firm information. Then dividend discount model approach. In case of dividend discount model approach, as we know, we are supposed to apply the formula P0 is equal to D1 divided by KE minus G. This is the formula to be applied. Once again, the value will be calculated based on like the proxy entity information. You can see that information is given that dividend payout 1 minus P for the proxy entity is 50%. So what will happen? Say as far as the earning is concerned, it is 10 crore. There is no synergic gain. Into the dividend payout ratio is 0.5. So this is the dividend. Further, you can see that there is growth rate information provided to us in the second point, that is 7%. So into 1.07. So this becomes D1 divided by cost of equity, which we have calculated, say, in the first part of the question. Whatever cost of equity that we have calculated in the first part of the question, that is 10.93%, less growth rate 7%. That is the way, so the price of the security, that is the value of the firm, can be found for XYZ in a way that's it, taking XYZ dividend payout ratio into account. It is 10 crore into dividend payout ratio of XYZ is 0.4 into 1.07 divided by 10.93% less 0.07. That is the way the answer will be calculated. Suppose, I do not know that what is answer. Suppose this answer is 80 crore and suppose this answer is 110 crore. Suppose. Then in that case, what we are required to do? We are required to understand like this. If at all there is a situation of no synergic gain, if at all there is a situation of no synergic gain, then out of these four values, 1, 2, 3 and 4, out of these four values, what is the least value? Least value is 80 crore. So no synergic gain, minimum value that we can offer is 80 crore. And what is the maximum value? 1, 2, 3, 4. Highest value is 120 crore. So if at all there is no synergy gain, 120 crore is the maximum value that we can offer. That is the way we understand this answer. If at all there is no synergy gain, then in that case, what is the maximum value that we can afford is 120 crore. And what is the minimum value? 80 crore. As per that, we are required to give suggested answer. Friends, over here, say with the information of the question, it is very difficult to understand that this is the answer that they are expecting. From the given question, it is very difficult to understand that this is the answer that they are expecting. That you are required to do valuation based on price earning ratio method. You are required to do the valuation based on dividend discount model method. You are required to do the valuation taking into account the proxy firm information. You are required to do the answer taking into account, say, the acquiring company information. These things, say, cannot be ascertained, say, unless we have the suggested answer. However, now we can say that if at all such kind of question is asked in examination, then this is the answer which is expected from us. Now we can understand that if at all these kind of questions have been asked, then in that case, this is the answer which we are required to give. And if at all there is synergy gain, you can see that information is provided in the very first paragraph. XYZ expects that after acquisition, annual earning of KLM will increase by 10%. So we understand that, say, instead of 10 crore, we are required to keep over here 11 crore. Instead of 10 crore, we are required to keep over here 11 crore. Instead of 10 crore, we are required to keep 11 crore. Instead of 10 crore, we are required to keep over here 11 crore. That is the way we are required to have entire revaluation. Once again, we will be having four values. 1, 2, 3, 4. Four values. Lowest value is the minimum value that we can offer. Highest value is the maximum value that we can offer if we are expecting that there is synergy gain. So this is the way you are required to calculate a range of the values, starting from minimum to maximum. Answer for the B part of the question in that first working note. calculation of the value of KLM in a situation of no synergic gain. We will do 4 valuation. 2 based on price earning ratio, another 2 based on dividend discount model. Price earning ratio based valuation will be made taking into account price earning ratio of the proxy firm and price earning ratio of acquiring company. Working note A, calculation of the value taking price earning ratio of proxy firm, that is earning after taxation into PE ratio. 10 crore into 12 times, it is 120 crore. Then working note B, calculation of the value taking price earning ratio of XYZ, that is our own price earning ratio. Earning after taxation into price earning ratio, 10 crore into 10 times, it is 100 crore. Please take down answer from board. So friends, working note number C is calculation of the value of KLM based on dividend discount model approach, DDM, taking into account dividend payout ratio, that is 1 minus B of proxy firm. P0 is equal to D1 divided by KE minus G. Dividend is like earning into dividend payout ratio is dividend. Earning into dividend payout ratio is dividend divided by KE minus G. At the end of first year, earning is year 0 earning into 1 plus G, that is earning at the end of year 1, into 1 minus B, that is dividend payout ratio, divided by KE minus G. Year 0 earning is 10 crore. It is growing at the rate of 7%. Into dividend payout ratio of 50%, divided by KE minus G. 10 crore into 1.07 into 0.5. That comes to 5.35 crore divided by 10.93% less 7%, 3.93%. So the value of the firm is 136.13 crore as per this. Please write an answer from board. Working note number D, calculation of value of KLM based on DDM and considering dividend payout ratio of XYZ. P0 is equal to D1 divided by KE minus G. D1 is E1 into dividend payout ratio divided by KE minus G. 10 crore into 1.07, that is earning at the end of year 1, into dividend payout ratio 40%, divided by KE minus C, and based on that value of the firm is found, it is 108.91 crore. Please write an answer from board. Working note number 2, calculation of EAT of KLM considering synergy gain. Current after taxes plus synergy gain, that is increase in earning by 10%. 10 crore plus 10% of 10 crore, 1 crore, so the revised earning is 11 crore. Please take an answer from board. Working note number 3, calculation of the value of target company, that is KLM, if there is synergy gain, taking into account the price earning ratio. Working note A, based on price earning ratio of proxy firm, that is earning after taxes into price earning ratio 11 crore, which we have calculated in second working note, into 12 times, that comes to 132 crore. Working note B, based on price earning ratio of our own, that is XYZ, EAT into price earning ratio 11 crore into 10 times 110 crore. Please take down answer from board. Working note C. Calculation of the value of KLM based on dividend discount model approach, considering dividend payout ratio of proxy firm. Same formula, P0 is equal to D1 divided by KE minus G. D1 is E1 into 1 minus B divided by KE minus G. E1 is 11 crore into 1.07 because there is synergy gain into dividend payout ratio divided by KE minus G. 11 crore into 1.07, 11.77 crore into 0.5 divided by KE minus G. 11.77 crore into 0.5, that comes to 5.885 crore divided by 3.93%, so 149.75 crore. Please take down answer from board. Friends, once again, calculation of the value of KLM based on dividend discount model approach, considering dividend payout ratio of XYZ. P0 is equal to D1 divided by KE minus G, E1 into 1 minus B divided by KE minus G. 11 crore into 1.07 into dividend payout ratio of XYZ 0.4 divided by KE minus G. So 11.77 crore into 0.7 into 0.4 divided by 3.93%. So 4.708 crore divided by 3.93%, 119.80 crore. Please write an answer from board. Here is the summary for without synergy gain, with synergy gain, values that we have calculated. Value based on price earning ratio, value based on dividend discount model approach, proxy firm XYZ, proxy firm XYZ. Like that, these 8 values we have calculated. We will see the column of without synergy gain. We will see the column of without synergy gain. In that, say this is the lowest value. In that, say this is the highest value. So if at all there is no synergy gain, range of valuation is 100 crore to 136.13 crore. If there is synergy gain, these are the values. Once again, this is the lowest value, 110 crore, and this is the highest value, 149.75 crore. Like that, say we are required to give range of valuation without synergy gain, with synergy gain, minimum value and maximum value. This is the answer of the question based on this working. Friends, once again I would like to repeat what I said earlier. From the question it is very difficult to understand that this is the kind of suggested answer that we are required to give. From the question it is very difficult to understand that this is the kind of answer that they are expecting from us. However, by doing this question we understand that say these kind of suggested answers that they are expecting. So accordingly, say we will be making calculation of answer for any such question which will be asked in examination. If in examination some new kind of question is there, then by applying our common sense, by applying the basic principles, by applying the concepts that we have studied, we are required to do the answer. We cannot cover up so the kind of like the suggested answer that they are giving if at all it is something new. I understand that as a student you will feel that how can I come to know for any of the new suggested answer that they are going to offer for any of the question which has not been asked so far. However, you don't worry. The kind of problem that you have as a student, say, is the problem that other students are also having. So whatever the kind of risk that you have as a student is the similar risk that other students are also having. So don't bother about the same. Further, out of like if at all we take the 8 papers of CA final examination, total 1000 marks including option, hardly there are 50 or 70 marks say is falling in this kind of gray area. Remaining it is within the reach. Remaining is already there covered by us in the studies that we do. So don't bother about those 50 or 70 marks, those special kind of problems. You just focus on your concept, and based on that definitely so you will be able to have good marks in your examination. The first thing is that the problem like this you do not only have, other students are also having. And the second thing, understand that say there is only very less portion of the total examination marks which is falling in this kind of gray area. Please write an answer from board. Question number 12A. Consider the following financial data of A Limited and T Limited just before the merger announcement of later, that is T Limited, by the former, that is A Limited. Information is given about two companies, MPS 150 rupees and 30 rupees. Number of shares 10 lakhs, 6 lakhs. Market value of the firm 1500 lakhs, 180 lakhs. If A Limited intends to pay rupees 240 lakhs in cash to T Limited, find out cost of merger, true cost of merger, apparent cost of merger, cost to A Limited, and NPV to T Limited. Second, if A Limited intends to offer 1,60,000 shares in exchange of shares of T Limited, assume further the merger is expected to generate cost savings with present value of 94.8 lakhs. It is expected that these cost savings would push up the market price. Find benefit of merger, cost of merger, true cost of merger, cost to A Limited, apparent cost of merger, NPV to T Limited and NPV to A Limited. Please go through the question, friends. Friends, let us enter into a new segment regarding calculation of cost of merger, calculation of benefit of merger, calculation of NPV of merger. In calculation of cost of merger, there are two calculations that we have. One is true cost of merger and another is apparent cost of merger. Benefit of merger is also given a name as gain due to merger. NPV of merger is calculated from acquiring company point of view and from target company point of view. As far as the cost of merger calculation is concerned, cost of merger calculation is always made from acquiring company point of view. As far as the gain or benefit of merger is concerned, it is calculated by taking both companies into account together. By taking both companies into account together. That is what we have as gain/benefit due to merger. These calculations we are going to make if at all consideration is offered in form of cash and if at all consideration is offered in form of shares. If consideration is offered in form of cash, then these calculations, and if at all consideration is offered in form of shares, then these calculations. That is the way we are required to have so the understanding of this new concept. First of all, we are going to have understanding if consideration is in form of cash. Let us see that how to make the calculation of all the answers. Friends, as far as the cost of merger is concerned, if at all consideration is offered in form of cash, then cost of merger is calculated as cash paid minus market value of T Limited before merger minus market value of T Limited before merger. That is the way cost of merger is calculated. If at all consideration is offered in form of cash, then in that case, whether we have been asked to calculate cost of merger or we have been asked to calculate true cost of merger, or we have been asked to make the calculation of apparent cost of merger, all these are one and the same thing. They are not different. If at all consideration is offered in form of cash, then whether to calculate cost of merger or true cost of merger or apparent cost of merger, it is calculated from shareholders of acquiring company point of view, and it is calculated as cash paid minus market value of T before merger. As far as this example is concerned, you can see that the consideration which is paid in form of cash is rupees 240 lakhs. Market value of T Limited before merger is provided rupees 180 lakhs. Difference of this is 60 lakhs. That is what we understand as cost of merger, true cost of merger or apparent cost of merger. In this question, we are required to make the calculation of NPV to A Limited. The question says that make calculation of NPV to T Limited. It is exactly the same as cost of merger, which is calculated from A company point of view. It is calculated as cash received. Minus market value of T before merger. What is the amount of cash received? Rupees 240 lakhs. What is market value of T before merger? 180 lakhs. So NPV to T Limited is 60 lakhs. That is the way simply the calculation is required to be made. Please write down a note. I am dictating a note to you. First point. In case of calculation of cost of merger slash true cost of merger slash cost to A Limited slash apparent cost of merger. We have to apply following formula. Following formula. Rather than that, cash paid minus market value of T Limited before merger. T Limited before merger. Full stop. Second point, cost of merger calculation. Cost of merger calculation is from A Limited point of view. From A Limited point of view. Full stop. Third point, NPV to T Limited, comma, in case of cash consideration. In case of cash consideration, is calculated by applying following formula. Written formula: cash received minus market value of T Limited. Market value of T Limited before merger. Before merger. Full stop. With paragraph write down, actually true cost of merger, and NPV to T Limited is always same. Is always same. Full stop. Answer for the first question: if consideration is in form of cash, cost of merger, true cost of merger, apparent cost of merger, cost to A Limited. Cash paid minus market value of T before merger, 240 lakhs minus 180 lakhs, that is 60 lakhs. Please take down answer from board. E part of the question, NPV to T Limited. Cash received minus market value of T before merger. 240 lakhs minus 180 lakhs, that is 60 lakhs. Please take an answer from board. Friends, in the second part of the question, you have been asked with the question, calculate benefit slash gain due to merger. Calculate cost of merger, that itself is cost to A Limited, that itself is true cost of merger. Calculate apparent cost of merger, and lastly NPV to T Limited and NPV to A Limited. Basically, this answer and this answer are same answers. That is true cost of merger, cost to A Limited, or NPV to T Limited. This answer and this answer is same answer. These answers are calculated from A Limited point of view. What amount of excess consideration paid? This answer is calculated from T Limited point of view. This answer is calculated from A Limited point of view. This answer is calculated from A Limited point of view. While benefit or gain due to merger, it is calculated by taking both the companies into account together. By taking both the companies into account together. That is the way we are required to make the calculation of answer. Students are requested to concentrate over here. Benefit or gain due to merger indicates overall appreciation in the market value of the merged firm, overall slash in total appreciation in the market value of the merged firm in comparison with two independent firms. In a way that we understand like this. Suppose market value of A Limited is 2, market value of T Limited is 3. However, the merged firm has a market value of, let us say, 9. Then in that case, 2 plus 3, 5 is subtracted from 9. So what is incremental? Incremental is 4. So this incremental 4 is considered as benefit or gain due to merger, which we are required to find in the first question. That is, market value of the merged firm is compared with the two independent market value of the two companies. Appreciation increase is considered as gain slash benefit due to merger. Whenever you have been asked with the question, calculate cost of merger, then in that case you always have to calculate true cost of merger. You do not have to calculate apparent cost of merger. Whenever you have been asked that calculate cost of merger, then calculate true cost of merger and not apparent cost of merger. In case of cash consideration, true cost of merger or apparent cost of merger, both of them are one and the same. However, in case of shares consideration, However, in case of shares consideration, true cost of merger and apparent cost of merger are different. So if at all the question is that calculate cost of merger, then we have to calculate true cost of merger and not apparent cost of merger. We will compute apparent cost of merger whenever we have been provided with that information specifically. Unless we have been provided expressly that calculate apparent cost of merger, we will always compute true cost of merger. Please write down a note. I am dictating a note to you. First point, benefit / gain due to merger is calculated by taking both companies into account. Both companies into account together. Full stop. It is calculated as appreciation of market value of merged firm, in comparison with market value of two independent firms. Market value of two independent firms. Full stop. With paragraph write down, we have to apply following formula to calculate gain / benefit due to merger. Full stop. Second point, in case of shares consideration, apparent cost of merger and true cost of merger are different. In case of cash consideration, both of them are same. Full stop. Third point, write down, if we have been asked to calculate cost of merger. We will find true cost of merger. Full stop. Next point, cost of merger, comma, true cost of merger, comma, apparent cost of merger, comma, NPV to A Limited, all these calculations are made. All these calculations are made from A Limited point of view. Full stop. Fifth point, NPV to T Limited is same as true cost of merger, comma, however it is calculated from T Limited point of view. Full stop. Friends are requested to stop writing. Let me explain you. In the A part of the question, we are required to find benefit / gain due to merger. This is what we are required to find. You can see, friends, it has been provided to us like this. Second line of the question, assume further merger is expected to generate cost savings with present value of 94.8 lakhs. So that is savings of expenses, and we have been provided with the present value of this, an amount of rupees 94.8 lakhs. Like that information is given. In the A part of the question, we are required to find benefit of merger. In order to calculate benefit of merger, first of all, we are required to make the calculation of market value of the merged firm. So working note number 1, calculation of market value of the merged firm. Market value of the merged firm is calculated as market value of A before merger plus market value of T before merger plus synergy gain. Market value of A before merger is 1500 lakhs. Market value of T before merger is 180 lakhs plus synergy gain of 94.8 lakhs. Summation of this, that is 1774.8 lakhs. That is what we understand is the market value of the merged firm. As far as the gain / benefit of the merger is concerned, as far as the gain / benefit of merger is concerned, it can be calculated as difference between market value of the merged firm and market value of A Limited plus market value of T Limited before merger. Market value of the merged firm is 1774.8 lakhs minus market value of A Limited before merger is 1500 lakhs plus market value of T Limited before merger is 180 lakhs. So it is 1774.8 lakhs minus 1680 lakhs. So it comes to 94.8 lakhs. That is the way we are required to find benefit / gain due to merger. So always remember that in order to calculate the benefit or gain due to merger, first of all we are required to find market value of the merged firm. Then by applying this formula, gain / benefit of the merger is calculated. Let us see, friends, answer for the A part, benefit / gain due to merger. For this, first of all, we are required to calculate market value of merged firm. That is market value of A before merger plus market value of T before merger plus synergy gain. Market value of A before merger is 1500 lakhs. Market value of T before merger is 180 lakhs. And synergy gain is 94.8 lakhs. That is discounted value of savings. So it is 1774.8 lakhs. Friends, earlier we have done similar kind of question number 2B. You may refer that, say if at all you want to have further understanding. Please write an answer from board. Working note number 2, gain / benefit due to merger. It is computed as the difference between market value of the merged firm and market value of A plus T before merger. Market value of A before merger 1500 lakhs, T before merger is 180 lakhs. Market value of the merged firm is 1774.8 lakhs. So 1774.8 lakhs minus 1680 lakhs, that is 94.8 lakhs. Please write an answer from board. The next question is calculate cost of merger. A Limited, T Limited and merge firm. MPS, number of shares, market value. This is the market value of the merge firm as per the calculation that we have done in the first part of the question. Number of shares of the merge firm. We can say it is 10 lakhs plus 1.6 lakhs. You can see that it has been provided that if A Limited intends to offer its 1.6 lakh shares in exchange of shares of T Limited. So against the 6 lakh number of shares, 1.6 lakh number of shares have been issued. So total number of shares of the merge firm is 11.6 lakhs. Now how we will calculate the cost of merger? Cost of merger means true cost of merger slash cost to A Limited. It will be calculated like this. We will calculate that what is market value attributable to shareholders of T Limited. What is the market value attributable to shareholders of T Limited in merged firm? In merged firm. In comparison with the market value of T before merger. In comparison with market value of T before merger. Whatever appreciation that shareholders of T Limited have due to merger is considered true cost of merger or cost to A Limited, or we can say that it is cost of merger. Everybody is requested to consider it over here. We know that market value of the merge firm is 1774.8 lakhs. Number of shares of the merge firm is 11.6 lakhs as we have calculated over here, into number of shares issued to the shareholders of target company, that is 1.6 lakhs. Market value of the merge firm divided by number of shares of the merge firm into shares issued to shareholders of target company. We can say that this is what the value attributable to shareholders of target company in merge firm, which will be compared with market value of target limited before merger 180 lakhs. Difference of these two is what we understand true cost of merger, cost to A Limited, or we can say that this is understood as cost of merger. I repeat this explanation once again. 1774.8 lakhs divided by 11.6 lakhs. So this is market price of equity share of the merge firm, price of one equity share of the merge firm into 1.6 lakh number of shares. So this is in total indicating market value attributable to shareholders of target company. Market value attributable to shareholders of target company minus market value of T before merger 180 lakhs. Whatever is the increase that shareholders of target company is getting due to merger is cost of merger. Like that calculation is required to be made. In case of shares consideration, whenever we are required to calculate true cost of merger, we need to know what is market value of the merged firm. We need to know what is the exchange ratio. We need to know what is the market value of T before merger. the first and foremost thing that we are required to do is calculation of the market value of the merged firm. In A part of the question, we already have calculated. So in B part of the question, we do not have to calculate that separately. Otherwise, the first working note would have been to calculate market value of the merged firm. This is one of the most important working that we have in our merger chapter. So be careful to understand it, be careful to learn it properly. Please write on a note. I am dictating a note to you. In case of shares consideration, comma, if we are required to calculate, cost of merger or cost to A Limited or true cost of merger, then we need to have following information. First, market value of merged firm, Second, number of shares of merged firm and shares issued to shareholders of target company, / exchange ratio, full stop. Third, market value of T Limited before merger, full stop. With paragraph write down, we are required to compare market value of T Limited with market value attributable to shareholders of target company for finding true cost of merger. Full stop. With paragraph write down, we have to apply we have to apply following formula. Following formula. Written formula: MV, market value, attributable to shareholders of target company minus MVT before merger. MVT before merger. Further write down MVM, market value of merged firm, divided by NM, number of shares of merged firm, into NT into ER, that is number of shares issued to shareholders of target company. Number of shares issued to shareholders of target company minus MVT, market value of T before merger. Number of shares of the merged firm is calculated as NA plus NT into ER. So this is what we understand as market price per share of the merged firm into NT into ER. So we understand that this is the number of shares issued to the shareholders of target company. MPS into shares issued to the shareholders of target company is indicating market value attributable to shareholders of target company minus MVT, market value of target company before merger. So this is the formula which we are required to apply for calculation of the answer. Let us see calculation of cost of merger. Market value attributable to shareholders of T Limited in merged firm minus market value of T Limited before merger. What is the market value attributable to shareholders of T Limited in merged firm? Market value of merged firm divided by number of shares of merged firm into shares issued to shareholders of T Limited. So this entire indicates market value attributable to shareholders of T Limited in merged firm minus market value of T before merger. Market value of the merged firm we already have calculated. It is 1774.8 lakhs. That is market value of the merged firm 1774.8 lakhs. Number of shares of the merged firm NA plus NT into ER. In this question directly you have been provided with the information about NT into ER, that is 1,60,000 shares will be issued into shares issued to the shareholders of target company, that is 1.6 lakhs minus market value of T Limited before merger 6 lakh number of shares having price of rupees 30, that comes to 180 lakhs. 1774.8 lakhs divided by 11.6 lakhs divided by 11.6 lakhs. Answer of this is 153 rupees. So 1,60,000 shares which we have issued to them have price of 153 rupees per share. So product of this two is 244.8 lakhs minus market value of T Limited before merger 180 lakhs. So the amount of total appreciation 64.8 lakhs, that is what we understand is the true cost of merger, is considered to be cost of merger, is considered to be cost to A Limited. Please take down answer from board. C part of the question, D part of the question, F part of the question. Same presentation, same answer as B part of the question that we have done. True cost of merger, cost to A Limited, NPV to T Limited. Same presentation of the answer and same value of answer as in B part of the question. 64.8 lakhs. Please take down answer from board. Let us see, friends, E part of the question. E part of the question says that calculate apparent cost of merger. Apparent cost of merger is calculated like this. Everybody is requested to concentrate over here. Do not write anything. It is MPS of A before merger, MPS of A before merger into NT into ER, that is shares issued to the shareholders of target company, minus market value of T before merger. That is the way apparent cost of merger is found. MPS of A before merger, you can see that it is 150 rupees. NT into ER, that is the shares issued to the shareholders of target company, 1.6 lakhs. Minus market value of T before merger, 180 lakhs. So 150 rupees per share into 1.6 lakh, that comes to rupees 240 lakhs minus rupees 180 lakhs, that comes to rupees 60 lakhs. This is considered to be apparent cost of merger. This is considered to be apparent cost of merger. We do not have to make the calculation of apparent cost of merger unless it has been provided specifically to us. Basically, apparent cost of merger is misleading. Basically, apparent cost of merger is misleading. You can see that in apparent cost of merger we consider that 1,60,000 shares of A Limited are issued. 1,60,000 shares of A Limited are issued, having market price of 150. So we paid 240 lakhs against their value of 180 lakhs. So 60 lakhs is excess consideration. That is the way we make the calculation of answer. However, it is wrong. However, this is wrong. You can see that, say, whatever the calculation that we already have done, we know that the market value of the merged firm divided by number of shares of the merged firm, 1774.8 lakhs divided by 10 lakhs plus 1.6 lakhs. So 1774.8 lakhs divided by 11.6 lakhs, that comes to 153 rupees per share. Actually, we have issued shares to them having value of rupees 153, because post merger, what is the value of A Limited? Value of A Limited is 153 and not 150. So true cost of merger, which takes market price of the security post merger, wherein any of the effect of the synergy gain is also incorporated. Wherein any of the effect of synergy gain is also incorporated. So 153 into 1.6 lakhs, this is the value attributable to the shareholders of target company, which is compared with market value of the target company before merger to make the calculation of true cost of merger. However, we are required to find apparent cost of merger if at all specific information for that is given. We understand that this is misleading. We understand that, say, from decision making point of view, this cost of merger calculation should not be taken into account. Like that, say, we understand the concept. However, the calculation is required to be made in this way. E part of the question, calculation of apparent cost of merger. It is MPS of A Limited before merger into number of shares issued to shareholders of target company minus market value of T Limited before merger. MPS of A before merger is 150 rupees per share. There are 1,60,000 shares which will be issued. So 1.6 lakhs into 150 rupees per share, that comes to 240 lakhs minus market value of T Limited before merger 180 lakhs. So the answer comes to 60 lakhs. Please take down answer from board. G part of the question, calculation of NPV to A Limited. Everybody stop writing, let me explain. One of the method by which we can make the calculation of answer is similar to what we already have done. It is similar to what we already have done for T Limited. That is market value attributable to shareholders of A Limited in merged firm minus market value of A before merger. That is the way the calculation can be made. What is market value attributable to shareholders of A Limited in merged firm? We can say it is market value of the merged firm divided by number of shares of merged firm into number of shares of A Limited before merger minus market value of A Limited before merger. Market value of the merged firm is an amount of 1774.8 lakhs. Number of shares of the merged firm, it is NA plus NT into ER, that is 1.6 lakhs, into number of shares of A Limited before merger is 10 lakhs, minus market value of A Limited before merger, it is an amount of rupees 1500 lakhs. We know that so this is 153 rupees per share, and there are 10 lakh number of shares minus 1500 lakhs. So 153 rupees per share into 10 lakhs, that comes to an amount of 1530 lakhs minus 1500 lakhs, that comes to rupees 30 lakhs. Like that, so you can make the calculation of answer. G part of the question, NPV to A Limited. Method number 1, market value attributable to shareholders of A Limited in merged firm minus market value of A Limited before merger. Market value of merged firm divided by number of shares of merged firm into NA before merger. So this is the value attributable to shareholders of A Limited in merged firm minus market value of A Limited before merger. Market value of the merged firm 1774.8 lakhs divided by NA plus NT into ER is the number of shares of the merged firm into NA before merger minus 1500 lakhs. 1774.8 lakhs divided by 10 lakhs plus 1.6 lakhs. So this is MPS of the merged firm into 10 lakhs minus 1500 lakhs. Answer of this component is 153 rupees per share into 10 lakh. Product of this two is 1530 lakhs minus 1500 lakhs, so it is 30 lakhs. Please take an answer from board. Let us have understanding of NPV of A Limited once again. Understanding that by method number 2. It is like this. Change in P0 into NA before merger. As we know that MPS of the merged firm itself is MPS attributable to shareholders of A Limited post merger. MPS of the merged firm itself is MPS attributable to shareholders of A Limited in merged firm. So we can say that MPS of the merged firm minus MPS of A Limited before merger. Difference of these two. Multiplying with number of shares of acquiring company before merger. MPS of A before merger 150. MPS of the merged firm is 153. So simply there is appreciation of rupees 3 multiplying with 10 lakh number of shares. So it is 3 rupees per share multiplying with 10 lakh number of shares. That comes to rupees 30 lakhs. That is what we understand is NPV to A Limited. G part of the question, NPV to A Limited. Method number 2 for that calculation. Change in P0 into NA before merger. MPS of the merged firm minus MPS of A before merger into NA, that is number of shares of acquiring company before merger. MPS of the merged firm, which we already have calculated, 153 rupees. MPS of A before merger 150. So that is appreciation of 3 rupees per share into 10 lakh number of shares. So it comes to 30 lakhs. Please take down answer from board. Let us see NPV to A Limited calculation by an alternative method. Method number 3. It is like this. Gain slash benefit due to merger is an amount of 94.8 lakhs. We know that 64.8 lakhs is NPV to T Limited, cost to A Limited, true cost of merger, cost of merger. It means that out of this 94.8 lakhs, 64.8 lakhs transferred to the shareholders of T Limited. So remaining balancing figure is an amount of rupees 30 lakhs. This is the advantage which goes to shareholders of acquiring company. Like that, so you can calculate this as balancing figure. That is what we understand as NPV to A Limited. G part of the question, NPV to A Limited. Method number 3, gain / benefit due to merger minus true cost of merger. Gain / benefit due to merger is 94.8 lakhs, which we have calculated in the very first part of our answer. True cost of merger is also what we have found, 64.8 lakhs. So it is 30 lakhs. Please take an answer from both. Let us have summary, friends, of the entire question. Very important question. First, calculation of gain / benefit due to merger. Formula is market value of the merged firm minus market value of A plus market value of T before merger. Second, calculations if there is cash consideration. A, calculation of cost of merger, true cost of merger, cost to A Limited, or apparent cost of merger. Any of these calculations will have the same formula and obviously same answer. Cash paid minus market value of T before merger. In case of cash consideration, NPV to T Limited, cash received minus market value of T before merger. Same answer as the A part of the question that we have seen, in a way that cost of merger. C, in case of cash consideration, NPV to A Limited, it is market value of the merged firm, which itself is market value attributable to the shareholders of acquiring company, minus market value of A before merger. In our question number 12C, in the third part of the question, we are going to solve it. However, right now I am writing this formula for your revision purpose. Third, if consideration is in form of shares. A part, calculation of cost of merger or true cost of merger or cost to A Limited or NPV to T Limited. Any of these things will have the same answer. Market value attributable to shareholders of target company in the merged firm. market value attributable to the shareholders of target company in the merged firm, that is market value of the merged firm divided by number of shares of the merged firm into shares issued to the shareholders of target company minus market value of the target company before merger. In case of shares consideration, calculation of apparent cost of merger. Unless it has been asked specifically to calculate apparent cost of merger, it will not be calculated by us. It is MPS of A before merger into shares issued to the shareholders of target company NT into ER minus market value of the target company before merger. Like that it is calculated. In case of shares consideration, calculation of NPV to A Limited. Calculation of NPV to A Limited. Formula 1, 2, 3. 3 formulas are there. 1, 2, 3. 3 formulas are there. First formula. Market value attributable to shareholders of A Limited in merged firm minus market value of A Limited before merger. That is market value of the merged firm divided by number of shares of the merged firm into shares into shares held by shareholders of acquiring company. Second, change in P0 into NA before merger. Change in P0 into NA before merger. MPS of the merged firm minus MPS of A before merger into NA, that is the number of shares of acquiring company before merger. Third, gain / benefit due to merger minus cost of merger. Gain / benefit due to merger minus true cost of merger. Like that, say we can calculate the answer. You are requested to take down the table from board. Let us see next question. Question number 12b. A question from Institute publication. As treasurer of Leisure Products Incorporation, you are investigating the possible acquisition of Toys. So information is given about two companies, Leisure Products and Toys. Leisure Products is acquiring company and Toys is target company. You have the following basic data: EPS, DPS, N, P0. You estimate that investors currently expect a steady growth about 6% in Toys earning and dividend. Under new management, this growth rate would be increased. Like that information is given. Without any additional investment required. A part of the question. What is the gain, or we understand benefit from acquisition? In the A part of the question, we are required to calculate the gain / benefit due to acquisition, that is due to merger. I would like you to do first part of the question on your own. Do on your own A part of the question. So friends, we have been provided with the information that leisure product has 100 shares with current market price of 90. Plastic Toys has 60 shares with current market price of 20. So we can say that as far as the market value is concerned, this is 9,000, this is 1200. From the given information, we will make the calculation of market value of the merged firm. We'll make the calculation of market value of the merged firm. From market value of the merged firm, market value of A before merger and market value of T before merger will be subtracted. This minus this 2 is considered to be gain / benefit due to merger. So this is the procedure which we are required to follow. Importantly, you can see that it has been provided that under new management, growth rate would be increased to 9% per year. From 6% it will increase to 9% like that information is given, without any additional investment required. So in this case, we are required to make the calculation of the market value of the merged firm as market value of L before merger plus market value of P considering revised growth rate. Market value of L before merger, in that we understand there are 100 number of shares at market price of 90 rupees per share. For Plastic Toys, there are 60 number of shares multiplying with revise the market price of equity share is required to be kept over here. So this is what we are required to apply as the formula to calculate the answer. Now, in order to make the calculation of revise the market price of the equity share, we will apply a formula P0 is equal to D1 divided by KE minus G, wherein we will take revise the growth rate. Revise the growth rate is provided as 9%. Revise the growth rate is provided as 9%. As far as the dividend per share is concerned, it is provided as 80 paise. As far as institute suggested answer is concerned, in these kind of questions, always the given dividend per share is taken as D1 and with that the calculation is made. Whenever we are required to make the calculation of the market value of the merged firm, with change in growth rate, it is assumed that the given dividend per share is D1. So we are required to take that as 80 paise divided by KE minus G. Now this cost of equity information is not provided to us directly. So what we will do, by taking into account existing information, we will make the computation of the cost of equity. What is D1? D1 is 80 paise. What is P0? P0 is 20 rupees. What is current growth rate? Current growth rate is 6%. So 0.80 divided by 20, that comes to 0.04, which is added to 0.06, that comes to 10%. So this is our step number 1. Taking revise the growth rate, we will make the calculation of revised P0. 80 paise divided by 1%, that comes to 80 rupees. So taking into account revise the growth rate, revise P0 is found. Revise the P0 is kept over here. So our step number 3, is calculation of the market value of the merged firm. 90 rupees per share into 100 number of shares, that comes to rupees 9,000, plus 60 shares into 80 rupees per share, that comes to rupees 4,800. Summation of this two is 13,800. So we can see that the market value of the merged firm is 13,800, which is compared with market value of A and T before merger. That is market value of leisure products and market value of plastic toys. Like that, say we make the calculation of synergy gain. Like that, we make the calculation of the gain slash benefit due to merger. That is an amount of 3,600. That is an amount of rupees 3,600. So that is for the answer for the A, first part of the question. I just repeat procedure for calculating answer. Procedure for calculating answer. Procedure for calculating answer is something like this. In our step number 1, taking into account existing information about target company, we calculate cost of equity. Step number 2, taking revised the growth rate, calculating revise the market price of the security, revise the P0, that is 80 rupees. Step number 3, calculation of market value of the merged firm, that is market value of L plus market value of P. Market value of leisure products will be same, and market value of plastic toys will be calculated taking into account or revise the growth rate. With that, the market value of the merged firm is found 13,800, which is compared with the market value of two independent firms before merger. So this is understood as benefit or gain due to merger. Like that, so the answer is required to be found. Answer for the A part of the question, calculation of gain slash benefit of the merger. In that working note number 1, calculation of cost of equity of Plastic Toys Incorporation considering details before merger. D1 divided by P0 plus G, 80 paise divided by 20 rupees plus 6%. 80 paise divided by 20 rupees is 0.04. To that 0.06 is added, so 0.10, that is 10%. Please take down answer from board. Working note number 2, calculation of P0 of target company taking into account revised growth rate. Revised growth rate is 9%. D1 divided by KE minus G. 80 paise divided by KE minus G. So 80 paise divided by 1%, that comes to rupees 80. Friends, importantly, if at all there is change in growth rate and we are required to make the calculation of the market value of the merged firm, then as per institute suggested answer, the given dividend is assumed to be D1, which is not required to be changed with the growth rate. We are absolutely following number of suggested answers that institute has given. Please take an answer from board. Working note number 3, calculation of market value of the merged firm. Market value of L before merger plus market value of P considering revised growth rate. NL into P0 plus NP into revised P0. This is very important for you to understand. NL before merger is 100 shares, price is 90. NP 60 shares, and this is importantly 80 rupees per share. So it is 9,000 plus 4,800, that is 13,800. Please take an answer from board. Let us see calculation of the gain slash benefit due to merger or acquisition. It is market value of the merged firm minus market value of L before merger plus market value of P before merger. Market value of the merged firm has been found by us 13,800 in earlier working note. Market value of L before merger is 100 shares into 90 rupees per share, and market value of P before merger is 60 shares into 20 rupees per share. So 9,000, 1200. So 10,200 subtracted from 13,800. So it is 3,600 rupees. Friends, always it is equal to revise the P0 of target company minus current P0 of target company into number of shares of the target company. As far as the plastic toys is concerned, that company had a value of 20 rupees per share. Revised value is 80 rupees per share, which is included over here. And there are 60 number of shares that target company has. So that 60 rupees appreciation per share into 60 number of shares, that comes to 3,600. Please take down answer from board. Friends, a situation in which growth rate of target company changes and with that market value of the merged firm calculation. We have done this kind of question earlier, question number 2D. You may refer that example if at all you want to see. Write on a note. I'm dictating a note to you. You are requested to write down answer along with me. First point. Whenever information is given about change in growth rate of target company, change in growth rate of target company, comma, then in that case, comma, we have to follow under mentioned steps, to calculate MVM, that is market value of merged firm. In that, write down A, calculate KE of target company, comma, using information before merger. Full stop. Importantly, given dividend per share, given DPS, dividend per share, is assumed to be D1. Full stop. B for Bombay, write down. Taking into account comma, KE calculated above, and revise the growth rate, underline the word revise the growth rate. We will make calculation of revise the P0, full stop. Importantly, value of D1 will not change. Full stop. Underline the word value of D1 will not change. C, MVM will be calculated as under. Write down formula. MVA before merger plus MVT considering revise the growth rate, full stop. Bus. Second point, write down. In this kind of question, gain / benefit due to merger equals to change in P0 into NT before merger full stop. That is synergy gain. Full stop. Let us see B part of the question. What is cost of acquisition? That is cost of merger. If leisure products pays rupees 25 in cash per share of plastic toys, so we are required to find cost of merger if consideration is in form of cash. Try to do on your own, friends. If confident, do working in your fair book, otherwise do working on the last page. So friends, over here it has been provided that consideration is paid in form of cash. In that case, we are required to have the working like this. That is cash paid minus market value of P before merger. ₹25 is paid per share, and there are 60 number of shares. However, P incorporation had value ₹20 per share, and there are 60 number of shares. So we understand that ₹1500 is paid against ₹1200 market value. What is excess consideration? Excess consideration is 300. So we understand that say ₹300 is cost of merger or true cost of merger for acquiring company. So friends, cost of merger is cash paid minus market value of P before merger. ₹25 per share and 60 number of shares. Market value of P is ₹20 per share and there are 60 number of shares. So 25 into 60, that comes to ₹1500, and 20 into 60, that comes to 1200. So ₹300 is cost of merger. Please take down answer from board. C part of the question. What is cost of acquisition if Leisure Products offers 1 share of Leisure product for every 3 shares of Plasti Toys, in a way that the exchange ratio is 1/3. 1 share is offered for every 3 shares of the target company. In this case, we are required to calculate cost of merger. Once again, try to calculate answer on your own. If confident, do working in your fair book. Otherwise, do working on the last page of your full scope book. Friends, the question is, what is cost of merger if Leisure Products offer 1 share of Leisure product for every 3 shares of Plasti Toys? So we understand that exchange ratio is 1/3. So 60 into 1/3. Number of shares of the merged firm will be 120. It is 100 plus 60 into 1/3. Like that we understand. As we know that in case of shares consideration, cost of merger will be calculated as market value of merged firm divided by number of shares of the merged firm into number of shares issued to the shareholders of target company minus market value of target company before merger. This is the formula to be applied to calculate the answer. We can see that the market value of the merged firm is 13,800 rupees. As we have calculated to calculate answer for the A part of the question, NA 100, NT into ER 20 shares into 20 shares minus market value of T before merger is rupees 60 shares into 20 rupees per share. So answer of this component is 115 into 20 shares minus answer of this component is 1200. So in a way that, so the shares worth 2300 issued to them and market value of target company before merger was 1200. So 1100 rupees is understood to be gain of merger / benefit of merger. Calculation of cost of merger if consideration is in form of shares. This is market value attributable to shareholders of target company minus market value of target company before merger. That is market value of the merged firm divided by NA plus NT into ER into shares issued to the shareholders of target company minus market value of target company before merger. 13,800 is market value of the merged firm. NA 100 shares, N2 60 shares, NT 60 shares, and exchange ratio is 1/3. So 60 into 1/3 minus market price of T Limited before merger 20 rupees per share. So we understand that 13,800 rupees divided by 120 shares into 20 shares. 115 rupees per share into 20 shares. 2300 minus 1200. So it is 1100. Please take down answer from board. D part of the question. D part of the question. In case of shares consideration, highlight the portion shares consideration. Calculate NPV to Leisure Products Incorporation. Try to calculate answer on your own. If confident, do working in your fair book. Otherwise, do working on the last page of your full scope book. Friends, in this part of the question, for acquiring company we are required to find NPV. Let us see that how we can calculate the same. Market price of equity share before merger is 90 rupees and 20 rupees. Number of shares are 160 before merger. Product of these two is the market value of L incorporation and P incorporation. In the first working note, we have calculated market value of the merged firm 13,800 rupees. One equity share is offered for every 3 equity shares of the target company. So 60 into 1 by 3. That comes to 20 shares plus 100 shares of acquiring company. So as far as the merged firm is concerned, there are 120 shares. Market value of the merged firm divided by number of shares of the merged firm will give answer of the MPS of the merged firm 115 rupees. All these calculations we already have done. I am just refreshing all these to make the calculation of the next answer. In order to make the calculation of NPV to acquiring company, there are different methods. Method number 1 is like this. First method is market value attributable to shareholders of acquiring company post merger minus market value of acquiring company pre-merger. In a way that said 13,800 is the market value of the merged firm divided by the number of shares of the merged firm into number of shares held by shareholders of acquiring company, that is 100. So it is 115 rupees per share into 100 rupees. Into 100 shares. That comes to 11,500 minus market value of acquiring company before merger 9,000 minus market value of acquiring before merger 9,000. Difference of this two is 2,500. That is what we understand is NPV to acquiring company, that is NPV to A Limited, that is 2,500 rupees. That is the method number 1 answer. Method number 2. Method number 2 is very simple. MPS of A Limited before merger is 90 rupees. Post merger it is 115. Pre-merger market price was 90. Post merger it is 115. So there is increase by rupees 25. Multiplying with 100 shares, that comes to rupees 2,500. That is what we understand as NPV to A Limited. At the same time, we can have method number 3. Method number 3 is like this, wherein we understand that, say, out of gain of merger, we are required to subtract true cost of merger, that is cost of merger. True cost of merger or cost of merger. Difference of this two is NPV to A Limited. True cost of merger is basically indicating NPV attributable to the shareholders of target company. So out of total advantage, NPV attributable to the shareholders of target company is subtracted and remaining is the NPV to the acquiring company. So we understand that, so the gain of the merger is 3,600 and true cost of merger, which we already have calculated, 1,100. So that comes to 2,500. In case of shares consideration, you just see we have calculated true cost of merger, or we can say that NPV to T Limited is 1,100. So remaining is the advantage which is attributable to the shareholders of acquiring company. Like that, by applying either first method or second method or third method, we can make the calculation of NPV to acquiring firm. Let us see, friends, calculation of NPV from acquiring company point of view, from Leisure Products Incorporation point of view, in case of shares consideration by adopting first method. It is market value attributable to shareholders of LP Incorporation, Leisure Products Incorporation in merge form minus market value of Leisure Products Incorporation before merger. Market value of merge firm divided by NL plus shares issued to the target company into NL, that is going to remain same, that is the number of shares held by shareholders of existing company minus market value of acquiring company before merger, that is NL into P0. Market value of the merged firm has already been found by us, rupees 13,800 divided by number of shares of acquiring company 100 plus shares issued to the shareholders of target company 20, multiplying with the shares held by shareholders of existing company 100. From this, market value of the target company is market value of acquiring company before merger is subtracted, that is 90 rupees per share into 100 number of shares. This is 115 into 100 shares, 11,500 minus 9,000, that is 2,500. Please take down answer from board. Let us see the same answer with different method of presentation. In examination, you just have to show any one of the method. Change in P0 into number of shares of L in corporation before merger. That is MPS of the merged firm minus MPS of L before merger into number of shares of L before merger. 115 rupees per share is the MPS of the merged firm as calculated in C part of the question. When we were calculating cost of merger, true cost of merger, at that time we have made this computation. Minus 90 rupees per share into 100 number of shares. So 115 minus 90, that comes to 25 rupees per share into 100 shares. That comes to rupees 2500. Please take down answer from board. Same calculation by third method. Gain slash benefit of the merger minus true cost of merger. Gain slash benefit of the merger 3600, true cost of merger 1100, so it is 2500. Please take down answer from board. Let us see E part of the question. Let us see E part of the question. If expected growth rate of Plastidoids, highlight the portion, were not changed by the merger. So the growth rate which increases from 6% to 9%. Growth rate which increases from 6% to 9%. If at all it does not increase like that, were not changed by the merger. Recalculate all four questions once again. So the question says that A, B, C and D, these questions are required to be calculated once again if at all growth rate does not change. I read A part of the question. What is the gain from acquisition? In a way that's in the A part of the question, we are required to calculate gain / benefit due to merger. That is what we are required to calculate. So in the E part of the question, we will make the calculation of EA, EB, EC, ED. As far as the question number EA is concerned, I would like you to do on your own. If confident, do working in your fair book, otherwise do working on the last page of your full scope book, please. Friends, in A part of the question, in order to calculate the gain / benefit of the merger, first of all we are required to make the calculation of market value of the merged firm. First of all we are required to make the calculation of market value of the merged firm. We understand that the question says that if expected growth rate of Plastidoids were not changed by way of merger. So in that case we understand that there is a situation that there is no synergic gain. There is a situation that there is no synergic gain. So market value of the merged firm can be calculated by two methods. Market value of the merged firm can be calculated by two methods. As far as the method number 1 is concerned, it is market value of L before merger plus market value of P before merger. That is the way market value of the merged firm can be found. And as far as the other method is concerned, the method number 2, it is earning after taxation of the merged firm, which is simply summation of earning after taxation of L before merger plus earning after taxation of P before merger, multiplying with weighted average price earning ratio. That is the way we are required to make the calculation of market value of the merged firm. This is the way the calculation is required to be made for market value of the merged firm first of all. Everybody is requested to stop writing, let me explain you. As far as the first method is concerned, in that the working will be made like this. Leisure products and Plastidoids. You can see that as far as the number of shares are concerned, it is 100 shares and 60 shares. Market price of the security is concerned, it is 90 rupees per share and 20 rupees per share. Market value, it is 9,000, it is 1200. So as far as the merged firm is concerned, it is 10,200. Like that simply market value of the merged firm calculation can be made by us. That is what we understand is the method number 1. The method number 2 is like this. In method number 2, leisure products and plastic toys, earning per share, it is 5 rupees and 1 rupee 50 paise. Number of shares, there are 100 number of shares and there are 60 number of shares. Product of this two is earning after taxation, that is 500 rupees and 90 rupees. Summation of this two is 590. So we understand that the earning after taxation of the merged firm is 590, which is required to be kept as a part of the calculation for calculation of the market value of the merged firm, that is 590 into weighted average price earning ratio. As far as the weighted average price earning ratio is concerned, it will be calculated something like this: leisure products and plastic toys, earning after taxes of leisure product is 590, for leisure products it is 500 and for plastic toys it is 90, so it is 590. So we'll make the calculation of weight / proportion. 500 divided by 590, that is 50 divided by 59. 90 divided by 590, that is 9 divided by 59. As far as the price earning ratio is concerned, price earning ratio is required to be calculated by us, that is MPS upon EPS. As far as the price earning ratio is concerned, it is required to be calculated by us. You can see that market price of the equity share is provided as 90 rupees, and on the other hand it is 20 rupees. 90, 20. So 90 divided by 5. So price earning ratio is 18 times, and over here 20 divided by 1.5, that comes to 13 1/3 times. So taking this price earning ratio pre-merger into account, that is 18 times and 13 1/3 times. This is the weight, summation of which is 1. Weight into price earning ratio, that is the way like weighted average price earning ratio of the merged firm will be calculated. Whatever the answer that we have of weighted average price earning ratio of the merged firm, that will be taken as the multiplier as of earning after taxation of merged firm. Whatever the weighted average price earning ratio of the merged firm that we have calculated will be taken as a multiplier of earning after taxation of merged firm, and with that market value of the merged firm will be calculated. So in order to calculate gain / benefit of the merger, the first working note that we are required to do is say calculation of the market value of the merged firm. And since there is no synergy gain, we understand that there are two methods by which we can make the calculation of answer. First is market value of acquiring company plus market value of target company is market value of the merged firm. That is the first method. And the second method is earning after taxation of the merged firm, which is earning after taxation of A before merger plus earning after taxation of T before merger into weighted average price earning ratio of the merged firm, which will be calculated by taking into account earning after taxation of each of the firm before merger and price earning ratio of each of the firm before merger. With that, we will make the calculation of the answer. Let us see answer for the E part of the question. In that A, calculation of the gain / benefit due to merger. In that working note number 1, calculation of the market value of the merged firm, which I do with method number 1. That is market value of L before merger plus market value of P before merger. Market value of L before merger is NL into P0 plus NP into P0. Number of shares of L incorporation before merger is 100 shares and its market price is 90 rupees per share. Number of shares of P Incorporation before merger is 60 shares and market price is 20 rupees per share. This is 9,000, this is 1200, this is 10,200. Please take down answer from board. Working note number 1 once again. Working note number 1 once again. In that, calculation of the market value of the merged firm with another method. In that, first of all, what we do, we make the calculation of earning after taxes. We make the calculation of the price earning ratio. Leisure Products Incorporation and Plastic Toys Incorporation. MPS 90/20, EPS 5:1.5. Price earning ratio is MPS upon EPS 18 times, 13 1/3 times. Number of shares 160. EPS into number of shares earning after taxes, EPS into number of shares earning after taxes, 590 respectively. Based on this information, first of all, we will make the calculation of weighted average price earning ratio of the merged firm, Leisure Products and Plastic Toys. Earning after taxes is 590. Summation of that is 590. Weight slash proportion 50 divided by 59. 9 divided by 59. Summation of that is 1. Weight into price earning ratio. Weight into price earning ratio. Based on that, weighted average price earning ratio of the merged firm is found. Earning after taxation of the merged firm into weighted average price earning ratio of the merged firm is market value of the merged firm. Earning after taxation of A before merger 500, T before merger 900. Weighted average price earning ratio is 1020 divided by 59. And answer of this equation is 10,200. That is the market value of the merged firm. Please take down answer from board. So answer of the A part of the question, calculation of gain due to merger. It is market value of the merged firm minus market value of two independent firms before merger. Merged firm market value has been calculated by us by two different methods, 10,200 minus market value of L before merger plus market value of P before merger. Market value of L before merger is 90 into 100, 90 rupees per share into 100 number of shares, 20 into 60, in that say 20 rupees per share into 60 shares. So it is 9,000, it is 1200. So there is no gain slash benefit due to merger, like that we can see. Please write an answer from board. Let us see B part of the question. What is the cost of acquisition if leisure products pay 25 rupees in cash per share of plastic toys? Try to calculate answer on your own. If confident, do working in your fair book. Otherwise, do working on the last page of your full scope book, please. Friends, in calculation of the cost of merger, in case of cash consideration, We just have to compare cash paid minus market value of target company, that is Plastitoys Incorporation, before merger. Everybody is requested to stop writing. Let me explain you. What is the amount of cash paid? 25 rupees paid per share, and there are 60 number of shares. Market value of P before merger is 20 rupees per share, and there are 60 number of shares. So it is rupees 1500 minus rupees 1200, that comes to rupees 300. Answer is remaining same as what we already have calculated in earlier part of the question. This answer, that is answer of question number EB, is exactly the same as B part of the question that we have done. The reason for that is very simple. We understand that, say, in calculation of cost of merger, if there is no shares consideration, only cash consideration is there, then in that case simply we are required to compare cash paid with the market value of target company before merger. With that, so the cost of merger is required to be found. We understand that, say, the market value of the merged firm is not taken into account in this calculation. So answer is remaining same as what we already have calculated above. So calculation of cost of merger in case of cash consideration. Cash paid minus market value of target company, that is market value of P Incorporation before merger. 25 rupees paid per share for 60 number of shares. Market value of P is 20 rupees per share, and say there are 60 number of shares. So 1500 is paid against value of 1200. So excess 300 which is paid is considered to be cost of merger. Please take down answer from board. Let us see C part of the question. What is the cost of acquisition? That is cost of merger. If Leisure Products offers 1 share of Leisure Products for every 3 shares of Plastitoys, that is, if at all consideration is offered in form of shares, then in that case we are required to calculate cost of merger. Once again, try to calculate answer on your own. If confident, do working in your fair book. Otherwise, do working on the last page of your full scope book prints. Let us see, friends, calculation of cost of merger. Calculation of cost of merger if exchange ratio is 1/3. Everybody is requested to stop writing. Let me explain you. The calculation is required to be made like this: market value of merged firm divided by number of shares of merged firm into number of shares issued to the shareholders of target company minus market value of target company before merger. This is the formula which we are required to apply. Everybody stop writing, let me explain. We already have calculated market value of the merged firm, that is 10,200, NA 100 shares, NT 60 shares, exchange ratio 1/3. So this is the market value of the merged firm into shares issued to the shareholders of target company, that is 60 into 1/3, minus market value of target company before merger, that is 60 into 20 rupees per share. So we understand that, say this answer 10,200 divided by 120 is price of 1 share into 20 shares which have been issued to them minus 1200 rupees. This is what we understand is cost of merger to acquiring firm. So answer for the C part of the question: calculation of cost of merger if consideration is in form of shares. Market value attributable to the shareholders of P incorporation in merged firm minus market value of P before merger. Market value of the merged firm divided by number of shares of the merged firm into shares issued to the shareholders of target company. This is the market value attributable to shareholders of target company minus market value of the target company before merger. Like that, true cost of the merger, cost to A Limited, will be found. So 10,200, which we have calculated by two methods, divided by NA plus NT into ER into NT into ER. So this is the value attributable to the shareholders of target company minus market value of the target company before merger. So 10,200 divided by 120 into 20. Like that, so it is 85 rupees per share into 20 shares, that comes to 1700 minus 1200. Like that, it is 500 rupees per share. it is 500 rupees. That is the cost of merger. Please take down answer from board. Let us see D part of the question. In case of shares consideration, calculate NPV to leisure products incorporation. Once again, try to calculate, answer on your own. We are required to find NPV to acquiring firm, that is NPV to leisure products incorporation in case of shares consideration. You are required to do working in fair book if at all you are confident, otherwise do working on the last page of your full scope book, please. Friends, this is the information that we have gathered so far. Leisure products, plastic toys, merge firm. Number of shares 160. Price 90/20. Product of this two, market value 9,000. Product of this two, market value 1200. Market value of the merged firm have been found by us by two methods. It is 10,200. Number of shares of the merged firm, NA plus NT into ER, that is 120 shares. Market value of the merged firm divided by number of shares of the merged firm. We already have found MPS of the merged firm, it is 85 rupees per share. Now there are three methods by which we can calculate NPV for acquiring firm. Method number one is calculate market value attributable to shareholders of A Limited. That is market value of the merged firm divided by number of shares of the merged firm into number of shares of acquiring company minus market value of acquiring firm before merger. So it is 85 rupees per share into 100 shares minus 9,000. So it is 8,500 minus 9,000. So we understand that NPV is 500 rupees negative. This is the first method. Second method is very simple. MPS of the merged firm minus MPS of A before merger, 90. 85 minus 90, 5 rupees negative into 100 shares, 500 rupees negative. We understand that, so the NPV to A Limited is MPS of the merged firm minus MPS of A before merger. Difference of that is the decrease in the market price of the share, multiplying with the number of shares of acquiring firm before merger, 100. That comes to 500 rupees once again. And the third and the last method, wherein NPV of A Limited is calculated as benefit of the merger slash gain due to merger. Benefit slash gain due to merger minus NPV to T Limited slash cost to A Limited. We know that there is no synergic gain, so benefit or gain due to merger is 0 minus cost to A Limited has already been found. It is 500 rupees in the earlier question, so NPV to A Limited is 500 negative. Like that you can make the calculation of answer. One of the three method is required to be adopted for calculation of answer. Let us see, friends, method number one for calculation of NPV to A Limited. Market value attributable to shareholders of Leisure Products Incorporation in merged firm minus market value of Leisure Products Incorporation before merger. In that, market value of the merged firm divided by number of shares of the merged firm into number of shares of A Limited. That is 10,200 divided by 100 plus 60 into 1 by 3 multiplying with 100. So 10,200 divided by 120 into 100. This comes to 8,500 minus 100 into 90 rupees per share, 9,000. 8,500 minus 9,000, so it is 500 negative. Please take down answer from board. Method number 2, change in P0 into number of shares of leisure products before merger. That is MPS of the merged firm minus MPS of leisure products before merger into number of shares of leisure products in corporation before merger. MPS of the merged firm, which we already have calculated earlier, it is 85 rupees per share minus MPS of leisure products before merger 90 rupees. Difference of this is 5 rupees negative into 100 shares, that comes to rupees 500 negative. Please take down answer from board. Method number 3, in that gain slash benefit due to merger minus true cost of merger. 0, because there is no synergy gain. Minus 500, so it is 500 negative. Please take down answer from board. Friends, let us have summary of the entire question. There are two segments in the question. There is change in the growth rate. There is no change in the growth rate. Change in the growth rate wherein growth rate increases. It means that there is synergy gain. There is synergy gain. No change in growth rate means there is no synergy gain. Like that, say we have these two different situations. In the first situation, we can see that this synergy gain is distributed among the shareholders of target company and acquiring company. In case of shares consideration, rupees 1100 and rupees 2500. No synergy gain. Then NPV to target company is sacrificed from acquiring company. So 500 rupees is the amount of wealth transferred from shareholders of acquiring company to shareholders of target company. As far as the cash consideration is concerned, NPV to target company is the question, or cost of merger is the question. It is going to remain same in both the cases, because in that we just have to compare the cash paid with market value of the target company before merger. So we understand that, say, whether there is synergy gain or not, that is not a point to be concerned. Market value of the merged firm is not required to be found. 300 rupees is the cost of merger in either of the case. Please take down the summary only for your understanding purpose. Let us see question number 12C, a question from institute publication. AFC Limited wishes to acquire BCD Limited. So there is a company called AFC Limited which wishes to acquire BCD Limited. So AFC is A Limited and BCD is T Limited. The shares issued by the two companies are 10 lakhs and 5 lakhs respectively. Number of shares: 10 lakhs for acquiring company and 5 lakhs for target company. Calculate the increase in the total value of BCD Limited resulting from the acquisition, resulting from the merger, on the basis of following conditions. Current expected growth rate of BCD Limited 7%. So as far as BCD Limited is concerned, growth rate presently it is 7%. Expected growth rate under control of AFC Limited without any additional investment and without change in risk of operations 9%. So growth rate from 7% it will increase to 9%. Current market price of AFC Limited 100 and for BCD Limited it is 20. Current dividend per share of BCD Limited is 60 paise. So dividend per share is 60 paise. Now from this information, the question says that calculate the increase in the total value of BCD Limited resulting from the merger on the basis of following conditions. It means that if at all there is change in the growth rate of the target company without any additional investment, without any change in the risk of the operation, then in that case, what is increase in the value of the target company? Simply, it means that what is gain slash benefit due to merger. Simply the question says that calculate gain slash benefit due to merger. That is the question. Friends, this is an institute publication question, and as I told you in the last question, that always it is assumed that for target company, whatever the dividend per share which is given to us, for target company, whatever the dividend per share which is given to us is assumed to be D1. So we'll assume that D1 60 paise for our computation. Further, in calculation of revised P0, taking into account the revised growth rate, the amount of D1 will remain same. Amount of D1 will not change, that will remain same, 60 paise per share itself. Calculate answer for the first question on your own, that is the gain slash benefit due to merger. If confident, do working in your fair book. If not, do working on the last page of your full square book, please. Friends, first part of the question is calculate the increase in the total value of BCD Limited resulting from the merger on the basis of following conditions. Over here for BCD Limited, this is the information given to us. Current market price of equity share 20, expected dividend per share 60 paise, current growth rate 7%, revised the growth rate 9%, number of shares 5 lakhs. We understand that, say, in order to make the calculation of like increase in the market value of target company, we have to apply a kind of formula like this. The formula is revised P0 minus current P0 into number of shares of BCD Limited. Current P0 is provided to us in the example 20 rupees. Number of shares of BCD Limited is provided 5 lakhs. Now revised P0 is required to be found. For calculation of revised P0, we have to apply the formula P0 is equal to D1 divided by K minus C. Dividend discount model approach is required to be adopted. Expected dividend per share, as I told you, will remain same in spite of the fact that growth rate is changing as per institute suggested answer. And the given dividend per share is assumed to be D1. Growth rate is 9%, that is the revised growth rate. Now as far as the cost of equity is concerned, it is not provided to us. However, the question clearly provides information which is assumed otherwise also, that there is no change in the risk of the operation. So whatever is the present cost of equity itself is revised cost of equity. Present cost of equity will be calculated by applying this formula, that is D1 divided by P0 plus G. What is D1? D1 is 60 paise. What is current market price of equity share? Current market price of equity share is 20. And what is current growth rate? It is 7%. 60 paise divided by 20 rupees, that comes to 0.03 plus 0.07, that is 0.10, that is 10%. That is current cost of equity, which is going to remain same even after acquisition. So we'll take it over here 10%. So 60 paise divided by 1%, that comes to rupees 60 per share. Market price of equity share is 60 per share. So we can say that revised P0 60, current P0 20. So increase in P0 40 into 5 lakh number of shares. So we understand that the amount of synergy gain, that is increase in the market value of the target company due to merger, is rupees 200 lakhs. This is the way answer is required to be found. So I hope everybody is clear that, so these are 1, 2 and 3. 1, 2 and 3. There are 3 steps in which we are required to do answer. First, we'll make the computation of the cost of equity based on existing information. Taking revised the growth rate, we'll make the calculation of revised P0. Then we'll make comparison of revised P0 with current P0, that is increase in the market price of the share of the target company per share, multiplying with 5 lakh number of shares, that is number of shares of the target company. And with that we can make the calculation of increase in the market value of the target company due to merger. So answering first part of the question, in that working note number 1, calculation of KE of target company, that is BCD Limited, before merger. It is calculated considering existing information of target company, that is BCD Limited. K is equal to D1 divided by P0 plus G. So 60 paise divided by 20 rupees per share plus growth rate 7%. 60 paise divided by 20 rupees, that comes to 0.03 plus growth rate 0.07, 0.10, that is 10%. Please take down answer from board. Let us see calculation of revised P0 of target company. We know that K is equal to D1 divided by P0 plus G. G is transferred on this side. So K minus G is equal to D1 divided by P0. P0 transferred over here and K minus G transferred over there. So we understand that P0 is equal to D1 divided by K minus G. What is D1? 60 paise. What is K? 10%, which we have calculated in first working note. A revised growth rate provided 9% to us in the example. So 60 paise divided by 10% minus 9%, that is 1%. That comes to 60 rupees per share. Please take the answer from board. Working note number 3, that is answer for the first question. Calculation of change, delta sign of change in market value of target company, that is BCD Limited, due to merger, due to acquisition. Revise the P0 minus current P0 into number of shares of BCD before merger. Revise the P0 is 60, current P0 is 20 into 5 lakh number of shares. So increase in P0 by 40 rupees per share. So 40 into 5 lakhs, that comes to an amount of rupees 200 lakhs. That is increase in the market value of the target company, that is synergy gain, that is gain slash benefit due to merger. Please take down answer from board. Let us see second part of the question. On the basis of aforesaid conditions, that is on the basis of above conditions, calculate gain or loss to shareholders of both the companies. If AFC were to offer one of its share for every 4 shares of BCD Limited. The question says that if at all the exchange ratio is 1:4, then in that case you are required to make the calculation of like NPV to the shareholders of AFC Limited and NPV for shareholders of BCD Limited. That is the question. You are requested that try to calculate answer on your own. If confident, do working in your fair book. If not, do working on the last page of your full scope book, please. Students are requested to concentrate over here. Do not write anything. Number of shares of AFC Limited before merger 10 lakhs. BCD Limited before merger 5 lakhs. P0 120 respectively. So this is the market value of AFC before merger. This is the market value of BCD before merger. As far as the merged firm is concerned, market value of the merged firm is 1300 lakhs. That is market value of A plus market value of T considering revised P0. And the revised P0 is 60 rupees per share multiplying with 5 lakh number of shares. So it comes to 300 lakhs plus 1000 lakhs, that comes to 1300 lakhs. Exchange ratio is 0.25, that is 1 for every 4 shares held. So 1 divided by 4 into 5 lakhs, that comes to 1,25,000 added to 10 lakhs, that is 11,25,000. So friends, we understand like this. Market value of the merged firm 1300 lakhs divided into two parts. One portion for AFC Limited and another is for BCD Limited. For AFC Limited it is 1300 lakhs divided by 11.25 lakhs multiplying with 10 lakhs. This is the market value attributable to the shareholders of acquiring company. While for BCD Limited it is 1300 lakhs divided by 11.25 lakhs into 1.25 lakhs. This is the market value attributable to the shareholders of target company. This value will be compared with value of acquiring company before merger, that is 1000 lakhs. In case of BCD Limited, this value will be compared with market value that it had before merger, that is 100 lakhs. And we can say that difference of this two is NPV to A Limited. Difference of this two is NPV to B Limited. That is the way the calculation is required to be made. Answering second part of the question, in that working note number 1, calculation of the market value of the merged firm, that is market value of AFC Limited before merger plus market value of BCD considering revised the growth rate. It is number of shares of AFC before merger into P0 of AFC. Number of shares of BCD Limited before merger into revised P0 importantly. Number of shares of AFC Limited before merger 10 lakhs, price 100. Number of shares of BCD 5 lakhs and 60 rupees per share is revised the market price of the equity share. So 1000 lakhs, 300 lakhs, so it is 1300 lakhs. Please take the answer from board. Let us see calculation of NPV to BCD Limited. Market value attributable to shareholders of BCD Limited in merge firm is compared with market value of BCD before merger. That is market value of the merge firm divided by number of shares of the merge firm into shares issued to the shareholders of target company. So this is the value attributable to the shareholders of target company in the merge firm minus market value of the target company before merger. Market value of the merge firm, which we already have calculated in earlier working note, that is 1300 lakhs, divided by NA plus NT into ER into NT into ER minus market value of the target company before merger. So 1300 lakhs divided by 10 lakhs plus 1.25 lakhs, that is 11.25 lakhs into 1.25 lakh minus 100 lakhs. Answer of this component is 115.55, that is 55555, which is represented at like 55 raised to slash into 1.25 lakh. It is 144.444444 lakhs minus 100 lakhs. Like that, NPV to the target company is 44.44 lakhs. Please take down answer from board. Let us see calculation of NPV of AFC Limited by first method. It is market value attributable to shareholders of AFC Limited in merge firm minus market value of AFC Limited before merger. That is market value of the merge firm divided by number of shares of the merged firm into shares of acquiring company minus market value of the acquiring company before merger. Market value of the merged firm has already been found by us. It is 1300 lakhs divided by number of shares of the merged firm into shares of acquiring company minus market value of acquiring company before merger. Market value of the merged firm divided by number of shares of the merged firm into number of shares of acquiring company minus market value of acquiring company before merger. It is 115.55 into 10 lakhs. So 1155.55 lakhs minus market value of acquiring firm before merger 1000 lakhs. So it is 155.55 lakhs. That is 55555, which is indicated like this. Please take the answer from board. Let us see calculation of NPV to AFC Limited by method number 2. That is change in P0 into number of shares of AFC before merger. That is MPS of the merged firm minus MPS of AFC before merger into number of shares of AFC Limited. MPS of the merged firm, which we already have calculated, it is 115.55 minus 100 into 10 lakh number of shares. Like that, say 15.55 into 10 lakhs, that is 155.55 lakh is the gain slash benefit to shareholders of acquiring company. Please take down answer from board. Once again, calculation of NPV of AFC Limited by third method, that is gain slash benefit due to merger minus true cost of merger slash NPV to BCD Limited. Gain slash benefit due to merger is 200 lakhs as calculated in the first part of the question, minus true cost of merger is 44.44444444 lakhs. Subtracting this, we find it is 155.555555 lakhs. Please take an answer from board. Let us see third part of the question. Calculate the gain to the shareholders of both the companies. If AFC Limited pays, highlight the portion, rupees 22 for each share of BCD Limited. So the consideration is 22 rupees per share. Assuming the price earning ratio of AFC Limited does not change after the merger. EPS of AFC Limited is 8, BCD 2 rupee 50 paise. It is assumed that AFC Limited invests its cash to earn at the rate of 10%. So friends, we are required to make the calculation of NPV to BCD Limited and NPV to AFC Limited. You are required to do this working on your own. If confident, do working in your fair book. Otherwise, do working on the last page of your full scope book, please. Friends, as far as cash consideration is concerned, in that NPV to target company that is NPV to BCD Limited, can be calculated easily like this: cash received minus market value of BCD before merger. That is the way we can make the calculation of answer. What is cash received? It is 22 rupees per share. There are 5 lakh number of shares. Minus market value of BCD before merger, that is 20 rupees per share into 5 lakh number of shares. So it is 110 lakhs minus 100 lakhs, that comes to 10 lakhs. That is the way simple NPV to BCD Limited can be found. So friends, third part of the question, calculation of NPV to BCD Limited if consideration is in form of cash. It is cash received minus market value of BCD before merger. The amount of cash received is 22 rupees per share for 5 lakh number of shares. So 110 lakhs minus 20 rupees per share into 5 lakhs, that is 100 lakhs. Difference of this two is 10 lakhs. That is what we understand is the NPV to the target company. Please take down answer from board.